Spencer, I've just taken a step back and I suddenly started thinking about 1984, 1985 in the UK, the devastating coal miners' strikes, the NUM, Arthur Scargill, devastating societally, but a real change in how Britain saw its future energy-wise. Given what we saw yesterday with the Prime Minister as well, talking about wind turbines for all by 2030 and a new hydrocarbon-free world, are we seeing something bigger here from this Norwegian dispute, i.e. this is going to be a huge societal change, a huge change in how we use our energy, and actually Norwegian oil and gas workers are just on the wrong side of history?
Hi, good morning. I think you're right. There are some parallels. We are starting an energy transition away from oil. But I think it won't be as dramatic, nowhere near as dramatic as what we saw in the 1980s. So what's happening in Norway? Oil companies are under financial pressure, having to keep a very tight control of costs, and there's an understandable pushback from the workforce against that, resulting in the strikes that we're seeing.
In terms of the investment in the products, and Spencer, you and I have spent many hours looking at the concerns about investing in hydrocarbons. I'm not worried actually about the investment in alternatives. I think there's plenty of money from an ESG point of view flooding into that. But if we don't get enough investment in keeping current production facilities up and running for the next 5 to 10 years during this transition, are we going to find a really big problem here? Because for many investors, certainly in the West, it seems untenable now to invest in that area.
This conversation is always the conversation that happens after a price slump. So, in the last 20 years, there's been something like 4 slumps in the price of oil, and every single time the worry is, is that going to crush upstream investment and result in an oil shortage in the next 3, 4, 5 years? It's never happened before. We still think it's unlikely to happen this time. Right at this moment, there is around 8 million barrels per day of spare capacity, which is being voluntarily shut down to try and keep the market balanced. So really, in terms of the global oil market, what's happening in Norway is pretty irrelevant in terms of market influence. It's 0.3% of the world's demand, when you've got 8% of the world's demand, which is voluntarily ready to go if it is required. At the moment, there's way too much oil compared with the world's demand. And until coronavirus goes away, that situation won't change.
Yeah, Spencer, and that leads us neatly into the conversation around stimulus, doesn't it? Because it does feel as though the day-to-day price is really being determined by the president's Twitter account and how likely it is that we will get that follow-through stimulus. What's your read on what the margin or perhaps the range on the price is at the moment related to the stimulus?
I still think it's less. Stimulus will have a small effect, but less. The oil price is more tightly range bound than maybe ever. Maybe more than the 20 years that were mentioned. Oil price has barely budged since the beginning of June at just above $40 per barrel, and I think it's unlikely that it will move for the foreseeable future, because there is, regardless of stimulus, there is a whole group of oil producing countries who are ready to make adjustments to what they produce, either further cuts or very, very slow increased production as world demand, if and when it does recover. And so effectively they are the ones controlling the price, and they seem to have settled for $40 being okay, and that's where we are.